Are you unknowingly setting yourself up for a massive tax bill in retirement? Welcome to the Lawyer Millionaire, where we deliver financial planning insights and business strategy for ambitious law firm owners so you can enjoy more time, more abundance, and less stress, even if you're still growing your practice. Imagine this. You've worked hard building your law firm and saving for retirement, but instead of enjoying the fruits of your labor, you're hit with a surprise tax bill and forced withdrawals you didn't see coming. Roth conversions could be the answer. Here's a proactive thought. You could have millions saved for retirement, but lose a huge chunk to taxes simply because you didn't plan ahead. Roth conversions aren't just a tax strategy, it's a way to take back control of your financial future. Well, what is a Roth conversion? A Roth conversion allows you to transfer money from a traditional IRA or 401k, which are pre tax accounts, into a Roth IRA. This move triggers taxes on the amount that you convert. It's going to be subject to income taxes, but the payoff can be significant. Your money grows tax free, withdrawals are tax free, and unlike traditional IRAs, Roth IRAs don't have required minimum distributions or RMDs, which start at age 73 or 75 if you were born after 1960. This means you can let your money grow tax free for as long as you want. And when you do withdraw it, it won't increase your taxable income. Well, why should you care as a law firm owner? Let's talk about why Roth conversions matter for most law firm owners. Many law firm owners have been diligent about saving into their pre-tax accounts like 401ks and SEP IRAs. A lot of people I talk to, they've built up their pre-tax accounts pretty sizably. And these are great tools for reducing taxes now, but they come with a future price tag. When it's time to withdraw those funds, they are fully taxable. And required minimum distributions can force you to take out more than you need, pushing you potentially into a higher tax bracket. Failing to plan for this can lead to serious consequences. Imagine being in your 70s, retired, and facing higher taxes all because of RMDs you didn't account for. Now, add in the fact that tax rates are likely going to increase over time. A Roth conversion allows you to address this proactively, paying taxes now at what are likely lower rates, especially, with the current Tax Cuts and Jobs Act, which was passed in 2017 and is now likely to be extended for a little bit of time. We have an opportunity to take advantage of some Roth conversions. Now, there are some other key consequences. So when you get into your 70s and you have to start taking RMDs, that additional income not only, increases your taxes, obviously, because you have more income, especially if you don't necessarily need that income. Your RMDs increase over time because your RMDs are based on your life expectancy. So the IRS has these tables and they start out, I think it's 129th. It's based on average life expectancy. And then each year, the amount you have to take increases. Okay. So you may find yourself later in life where you're having to take out large amounts, and this is forcing you into a higher bracket. Not only that, it's going to raise your Social Security taxes, your taxes on your Social Security benefits. It's also going to raise potentially your Medicare premiums thanks to IRMA, right? So there's a lot at stake here. Now, there's another big thing that not a lot of people think about, and we call it the widow's penalty. Okay. If you're married and one of you passes away, your spouse passes away, right? You then inherit their traditional IRA funds. Let's say you've got all this money in traditional IRAs. You're taking money out. You have your Social Security benefits. Now, here's what happens. When one of you passes away, you're going to lose one of your Social Security benefits, whichever is the lesser, right? If you made more money and you had a higher benefit, great. Your spouse's benefit's going to go away. Either way it goes, you're going to lose one spouse's IRA Social Security benefits. At the same time, you're going to potentially go into a higher tax bracket because you're going to go from married brackets down to single brackets. So you face the situation where income drops potentially and tax rates rise. Now, if you're taking RMDs, you're in higher brackets. And especially if you inherited IRA money from your spouse and you have larger RMDs to take, wow, you could wind up in a much higher tax bracket than you anticipated. This is called the widow's penalty. So, one helpful way to plan around that is Roth conversions, trying to get more money over into the Roth IRAs strategically when it makes sense. And Roth conversions is all about the timing of income. With the ability to do a Roth conversion, you have the ability to control when your money is taxed. And that's key, right? What we're trying to do is pay the taxes at the lowest effective rate, at the lowest possible rate, right? It's not about paying the least amount of taxes every single year. It's about making sure we pay the taxes at the lowest rate. And some years it might make sense to actually pay more in taxes by doing a Roth conversion and prepaying some taxes at potentially a lower rate. So here's how it works. When you execute a Roth conversion, you're essentially moving money from a traditional IRA or 401k into a Roth IRA. The amount you convert is added to your taxable income for the year, which means you'll pay taxes on it now. But once that money is in your Roth IRA, it grows tax-free, and you won't owe taxes on qualified withdrawals in the future. When to consider a Roth conversion? The timing of a Roth conversion is critical. So here's a few examples of when it might make sense. Low income years. If your income dips, for example, you're reinvesting in your firm or taking a break, it's a great time to convert. The economy has a tough year, income's down, fantastic. Great time for a Roth conversion. Number two, post-retirement, before your RMDs or required minimum distributions kick in. The years after you retire, but before RMDs kick in at age 73, are a golden opportunity because likely income is lower, right? And you're in a lower bracket. That's a golden time to do some Roth conversions. Number three, offset by deductions. If you have made large business investments or have significant deductions in a particular year, you can use those to reduce the tax impact of a conversion, right? Because it's going to lower your tax, lower your income, maybe even had a loss in the business because you had so many deductions. Great time to do a Roth conversion. How much should you convert? Well, one strategy is to convert just enough to avoid jumping up into the next tax bracket. We call that filling up the brackets. So if you're in the 22% bracket and you've got, $10,000 before you cross into the 24% bracket, go ahead and fill up that bucket, fill up that bracket. You're going to pay tax on your conversion at that 22% rate. Another is to spread conversions over several years, called laddering. It allows you to minimize the tax hit each year while still moving a significant amount of money into a tax-free Roth account. But I would caution that you want to do this strategically. You want to analyze your taxes every year, project where you're going to be, and do this smartly and strategically because let me tell you something. One of our clients was advised by his former advisor at a very large, reputable investment firm to convert $100,000 a year from his traditional IRA to his Roth IRA. Well, that's not a great idea. Just to go and do it blindly. A smarter plan would be to watch your income because he had a really high income year. He did this Roth conversion at the beginning of the year, $100,000, and you can't undo it anymore. They don't let you undo it anymore. So what ended up happening is it just, he just at a much higher rate than he needed to be. He ends up paying a lot more in taxes than he needed to pay. And then the next year, his income's lower. It's like, well, we should have skipped that year in Roth conversions and done it the next year. So it's really important to pay attention to your taxes and project those out. Now, let's dive into some ideas for law firm owners. If you are a business owner, leveraging those business deductions can be one way to try to drop your income in a particular year, right? And make that an opportunity year for you to do a Roth conversion. And one thing you want to watch out for is that if you're a high income earner, Roth conversions can trigger some unintended consequences, like the net investment income tax or higher Medicare premiums thanks to IRMA, IRMAA, the income something something. I can't remember what all the letters stand for right now. Um, Basically, at a certain point, if your income is too high, there's a surcharge on your Medicare premiums. So you want to plan carefully with a tax planner or financial planner who can really help you look at these things carefully. Um, Another consideration, if you're a law firm owner, thinking about succession planning. If you are preparing to sell your firm or transition to a partner, the years leading up to that sale could be lower income years compared to the years when you start getting paid from the sale itself. So those might be years where you do the Roth conversion. So think about that strategically. Years where your income is lower comparatively, take advantage of those lower tax years if you have those, and do your Roth conversions then. And there are big benefits in terms of estate planning. Roth IRAs are an excellent tool for passing wealth to the next generation. Under the Secure Act, heirs must withdraw inherited retirement accounts within 10 years. But with a Roth IRA, those withdrawals are tax-free. This can save your family, save your kids thousands in taxes, and make your legacy even more impactful. Okay, actionable next steps. Now that we've explored the ins and outs of Roth conversions, what can you do? Well, here we are at the end of the year. It's a golden opportunity time for Roth conversions. Number one, run the numbers. Start by estimating your current tax bracket for the current tax year and comparing it to your projected or past tax brackets, right? And what you think your tax bracket will be in retirement. Number two, plan for taxes. Make sure you have enough cash on hand to pay the taxes on the conversion, okay, without dipping into your retirement accounts. What you don't want to do is have the taxes withheld from the conversion. Sometimes you can do that, but if you're under 59 and a half, you're going to pay a penalty on that conversion or on having those taxes withheld. It's going to count as a premature distribution. So you don't want to do that. Number three, get expert advice. This is where working with a financial planner can be very helpful. Roth conversions can be complex, especially with the unique income streams and deductions that you as a law firm owner deal with. A customized plan will ensure that you don't leave money on the table. And finally, think long term. This is about optimizing your tax situation over the long haul. And doing this carefully and strategically can save you thousands of dollars over your lifetime. Now, we are not advocating for you want to convert everything over to the Roth. That wouldn't be smart, right? Because again, it's not about you don't ever want to be tax free because that means you paid too much tax in an earlier time. It's about making sure over your lifetime that your taxes are minimized. I'll give you another actionable tip. You want to make sure that you set up a Roth IRA right away if you don't have one, because there's a 5-year window. There's a 5-year window on taking distributions from a Roth IRA. There are actually 2 5-year windows. There's a 5-year window on the Roth IRA itself in terms of when it starts. So you can't take distributions tax-free until 5 years after you opened the IRA. And there's a 5-year window on conversions pre 59 and a half. Okay, so you want to pay attention to that very carefully. All right. So in summary, Roth conversions are a very powerful tool, and the end of the year is the time to do it because the deadline is December 31st. A very powerful tool in your financial planning toolbox. One of the biggest things that we look for and talk about with our clients every single year. So, and it's just one example of how proactive planning can make a huge difference. in your financial future. Here at the Lawyer Millionaire, we're here to help you with things like this: ideas, strategies to optimize your wealth, create and generate and protect your wealth, protect your business, and enjoy the rewards of the hard work that you've done over time. If you want to explore whether Roth conversions are right for you, let's connect. The link to my calendar is in the show notes. Schedule a call with me today, and let's create a tax efficient plan that works for you. Also, check out thelawyermillionaire.com, and you can learn more about all the great stuff that we do. You can even schedule a call with me there as well. This has been the Lawyer Millionaire Podcast. I'm your host, Darren Wurz. Thank you so much for joining me on this journey to expand your business, maximize your profits, and secure your financial future. I can't wait to connect with you again next time. Until then, take care and keep pushing forward.